Good evening. A mate of mine in Cape Town, Philip Weinstein, said to me when I was down there about 2 weeks ago that I should have a chat to tonight's guests. His name is Stephen Nathan. He runs a company called 10X Investments. Stephen, how did you get into this sordid game?
Well, it started in 1995. I finished my articles as an accountant, joined a stockbroker, which eventually became Deutsche Bank, as an equity research analyst.
So you are in the business of analyzing stuff?
That's what I did. I analyzed all the listed financial services companies, the life companies, the banks, the investment banks, the asset managers, both locally and also internationally. In 2001, I went offshore and I headed up Deutsche's global banking research. So I've got a bit of an international flavor there.
Now, when I had a chat with you, and it was a very interesting one, we'll get into that in just a moment, you gave me this particular book, The Little Book of Common Sense Investing by John C. Bogle. Who is this oak?
Well, John Bogle is the founder of a company called Vanguard, probably unknown almost in South Africa, but Vanguard is the biggest investment company in the US.
Right.
It's $1.5 trillion, which is bigger than the whole
$1.5
trillion. That's the size of the
I can't even see the zeros there.
It's
just too much.
It's huge. And John Bogle in 1974 founded a company called Vanguard.
Yeah.
And it was a massive departure from the traditional industry. I think South Africa is very much mired in what the US was like in the 70s, very much broker-driven, a lot of selling, a lot of commission incentives. And what Bogle did was really two things. The one is he stopped using brokers, he went direct, and he also introduced indexing, so not trying to outperform the market, but just match the market. And those principles founded Vanguard upon.
Now, he says in this book here, index funds eliminate the risks of individual stocks, market sectors, and manager selection. Only stock market risk remains. Do you agree with that then?
Yes.
And is that where you guys are headed?
Yeah, I think that investing involves risk. If you want to invest, you've got to take a bit of risk. And I think what Bogle says is that there's two kinds of risks. The one risk is rewarded. So if you invest in stock market, over time it's rewarded because you earn a return higher than if you just put it in the bank.
Okay.
And there's unrewarded risks. So trying to beat the market, most active funds don't beat the market. Some do, but about 90% don't. So that's an unrewarded risk. Paying high fees, it's an unrewarded risk because 9 out of 10 times you're funding someone else's retirement and not your own. So I think that's that's kind of what Bogle is getting at.
What sort of fees are we paying? And what should we be paying?
Okay. So the average cost of retirement investing, as measured by Rob Risconi, who's an independent actuary, is about 3%. So that's taken your total expenses expressed over your investment balance, about 3%. Some companies, a large company will pay less, and an individual will pay more. But that's the average. I mean, it's very difficult to find those numbers; they're not immediately apparent. But that's about the average. It's 3% of your investment value.
And what could you get it down to? I mean, if you had a squeeze, what could you get out of it?
Well, I think the way to look at it is what can you afford to pay away in fees? Because
I don't want to pay anything.
You've got to, but you have to look at the return, because what return are you likely to earn? And the return you're likely to earn over time after inflation is about 5% per year. So we don't think you should pay more than 1% in total fees. That's the maximum. You shouldn't pay more than 1%. Otherwise, you're paying away large amounts of your return that you could earn. Otherwise, if you had a low-cost fund, otherwise that's been paid away to an army of helpers out there.
So you're saying that on average we're only getting about a 5% return after cost. So that hard-earned money of yours, no matter where you're putting it, is probably, if you bulk it all together, is probably only getting you 5%.
That's exactly right. If you look at a balanced portfolio, I mean, although there's 1,000 different unit trusts and add on a few hundred other products, all your money basically ends up in the same place. It's going to end up in the stock market, the bond market, and listed property, cash. So it can get there 1,000 different ways, but it ends up in the same place. And those asset classes, over time, we've gone back since 1900, over medium to long-term periods, on average, you earn 5% after inflation.
What is a medium to long-term average, would you say? What sort of time span are you looking at?
Well, to be honest, it's from 5 years and above. that's the average, but there's obviously lots of variability. So the shorter your time horizon, if you're a 3-year investor, you can have a lot of variability around the 5%. But if you're a 40-year investor, you get very little. So that's kind of what risk is to say how much variability around what I expect. And the longer your time horizon, there's very little variability. So the 5% is it's a good number to bank upon. And I think the problem in South Africa is we've had high inflation. So people have seen the cost of living grow at 5–10%. In fact, it's been 10% has been the average over 40 years inflation. So the returns people are used to getting are about 15%. 10% inflation, 5% the real. That's the 50. Okay. But what happened is that although you thought your money was compounding, growing at a high rate, most of that was inflation. So you can say I get 15%, take away 10% for inflation, I've got 5 left, take away 3 for costs, I've only got 2 left. So my wealth is only growing at 2% after inflation and costs.
Are we living in a dream world here where we're thinking that we're actually doing very well for ourselves, but in fact, we're not?
I think that if you speak to people that are retiring, have retired, they've been saving diligently for 30, 40 years, and they've been in a high-cost product, then they know they're not living in a dream world. But I think you're right. I mean, most of us, it is a bit of a fool's paradise.
So, now you see, now you're making me scared. Now I'm getting worried because I'm at that stage where I don't have a heck of a lot of time left. Maybe 10, maybe 15 years. I have been planning for my retirement, and now I'm starting to think, have those plans been put in the right place? What do you do? How do you get, are there ways of getting yourself assessed? I mean, I go for a medical every year. Surely there should be a financial medical available as well, where you can sit down with a doctor of finance and he looks at you and goes, China, you are going to have a problem with that and the problem with that if you don't do this. Surely we should be doing that.
I agree with you completely. Unfortunately, the investment industry is not quite the medical industry. Those standards don't apply. So there aren't strict principles of how you should do exactly what you're trying to say, which is not really that hard. Because really, simply put, you could do this on an Excel spreadsheet. You say, I'm 45 today. I've got 100,000 Rand invested. I'm putting away 2,000, 5,000 a month. You need to grow that return. You can do them on a relatively simple Excel spreadsheet. How much am I going to contribute? What return am I going to earn? But remember that your return is likely to be 5% after inflation. So just put that 5% number in. Find out what total expenses you're paying. That's not going to be so easy. It's going to have some difficult questions with whoever. Get the number, plug it in a spreadsheet, and realistically, that'll give you a sensible idea of what to expect at retirement. So if you're growing at 5% return, I'm paying 3% in fees, 2%, do it in a spreadsheet, that's the number. And you're right, you're probably going to be horrified. But the fact is that more than half of people that retire in South Africa that have been contributing to a retirement fund replace less than 30% of their final salary. So for every rand that they're earning before they retire, they're replacing less than 30 cents in the rand. And you need 60% just to maintain living standards. So to kind of be comfortable, you would want 60%, and more than half of people are at 30%. So the reality is that most people are going to fail. They probably don't know about it, and they probably don't know why, but it's going to happen.
So you've been putting money into a retirement fund for 40-odd years, let's say, and when you retire, what you actually need, you're only going to get half of that paid out to you.
It's possible because of costs. It's possible.
Jeepers.
I must say that another very important reason why people don't have enough money, we can't just blame costs. I mean, costs are a big issue. It's probably the unspoken issue. But another issue that is more widely spoken about is people aren't saving enough. So people aren't saving diligently. You should try and put away 15% of your gross salary for a whole working life into a retirement fund. So even if you are doing that and you're paying high fees, then you're going to fail.
Why are these costs? You alluded to it, saying you'll have to ask some very difficult questions. Why aren't these costs declared up front? Surely they should be.
Well, the industry always tells you don't worry about costs. They say don't worry about cost, focus on returns. And all of the independent research shows you that the only thing you should worry about is costs, because the only reliable way to determine how well a fund is going to do over 10, 15 years is to look at costs. Because simply put, funds with high expense ratios produce worse returns than funds with low expense ratios. So low expense equals good for the investor, high expense equals bad for the investor. But typically what happens, people chase past performance. So last year was a great year, let's say, for resources. So everyone piles into resources. That's been proven to be the wrong way to invest. Review mirror investing is proven to be the wrong way. But it's really, I believe, salesmanship. Everyone's selling products, everyone's earning commission, everyone's having a good time at the expense of somebody else, at the expense of the client, and costs are unspoken. Don't worry about costs. Don't worry. If you get a return, the cost will take care of themselves. And the reality is that over time, your return's going to get close to that 5% real, and costs aren't going to take care of yourself. They're going to take care of someone else.
Let's get on to this indexing thing that I think I understand, but I'm not 100% sure about it. So you're tracking an index. How do you do that now?
Okay, well, the first step in investing is where do you invest your money in the investment mix, or what's called an asset class. So the asset classes people are most familiar with is the stock market, the all-share index. Okay. So that's an asset class. It's an index. But the index, the all-share index, it's published by the JSE, but it's a theoretical. You can't go and say to anybody, I want to buy the JSE. So you've got to go to a company that has a fund that replicates that. So it's just a mirror image. So if the JSE, for example, let's say, has individual shares, they're called constituents, that make up that index, and let's say Anglo American is 12.5% and Pick and Pay is 4.5%, then your portfolio is invested to mirror that
sort of way.
So
it's like a Satrix 40 type makeup.
That's exactly the principle. The Satrix 40 is a different index, but it's the same principle. That's the top 40. Okay. Unfortunately, there's these different indices. It's the all-share, the top 40, but you can get an index fund that replicates whichever index you would want.